Hello ladies and gentlemen, and a very warm welcome to today's webinar brought to you by sharedserviceslink.com and sponsored by BankTech. Today we're looking at how to improve the KPIs that you have for your exception handling process. So let's have a look at the speaker lineup for today. My name is Susie West. I'm the founder and CEO at sharedserviceslink.com, and I am the host for today's webinar, and I'm very pleased to be presenting as our main speaker James Selcock, who's the VP Business Development EMEA at BankTech. So let's have a look at your role in all of this. There was something compelling that made you sign up to today's webinar, and I'm assuming that's because you are looking to address your exception invoice problem, if we'll call it that. So make sure that you really do get your questions answered today in the next 60 minutes. And if at any point you feel that you aren't, or if you feel that our conversation is triggering our further questions, then make sure that you post your questions through to me, and I will put them through to James in the last 10 minutes of this webinar. The sooner you pass me through that question, the more likely it is to be asked. And make sure you do take advantage of that, and make sure you do stay on for the last 10 minutes of this show. So let's talk about why we're having this conversation today. Exceptions continue to be a pain for shared services organisations, and the handling of exception invoices is an investigation. It's an invoice that actually triggers an investigation within the organisation, which has huge costs associated with it because of the time spent investigating that transaction, and the inefficiencies surrounding that process stack up huge amounts of cost for the company. So one aim of a shared services organisation is, of course, to reduce those exceptions and try and get as many first-time match invoices as possible. But for many organisations, they will continue to have exceptions, and for many organisations, they will only have exceptions or non-PO invoices. So what this webinar is looking at is how to reduce the cost associated with managing those exception invoices or non-PO invoices, and to reduce the time spent on handling those transactions. So with that context in mind, I would now like to introduce James Selcock from BankTech. Over to you, please, James.
Thank you very much, Susie, and good afternoon, everyone. In this webinar, I plan to take a look at the subject of those invoices that really fall outside the normal standard process, the exception invoices. Now, these exception invoices I'm looking at are mainly to do with the non-PO type invoices. There are other forms of exception ones, obviously, that are PO related. But really, I'm looking at the non-PO ones that sit through the normal channels that really didn't start with a PO. As Susie mentioned in her introduction, there are millions of these that exist today and will continue to exist. The main cry that we hear is, how do people handle, or how do SFOs handle these invoices? There are obviously ways such as, sort of tougher controls, and indeed this way won't entirely remove them, because there always will be cases where there will be invoices that fall outside the standard process. The key is to be able to handle these invoices in a way that they can be processed effectively and then measured in a similar way to that of a standard PO-based invoice. Now, in the webinar, what I plan to do, as far as the agenda is concerned, what I like to do is try to, first of all, address the size of the non-PO market, and then take you through a case study which is based on a Swedish shared service organization that provides accounting services to all different types of companies, be they the micro businesses. Micro business, by my definition, or the definition I'm using, are the ones with a single person entity. We're all the way up to a large organization with a very complex structure, where, for example, an example of that could be BankTech itself, whereby we have a global operation with centers all across the globe, but how do we handle the invoices and non-PO invoices and the visibility and the global view of all those transactions. This company deals, the shared service company deals with mainly non-PO based invoices, where the volume of non-PO invoices is very high compared to other countries. It can be in the excess of around 90% of all invoices do not have a PO originated. And as part of the webinar, I would like to explain that by using an up-to-date cloud-based invoice processing platform that enables them to support and help them handle all forms of invoices, so therefore take a very much holistic approach, i.e. from paper to EDI, and which is easy to use and accessible on how the shared service provider can handle their requirements of its customer and deliver solid customer service, and at the same time meet its stringent KPIs that it's addressed. Finally, I'm going to finish off with an explanation of BankTech, and then I'd like to summarize the key points to take away from this seminar. But before we start, I'd like to hand over to Susie for the first question.
Thank you very much indeed, James. Just incidentally, there is a lot of KPI information coming your way over the next 60 minutes, so I hope you've all got a pen and paper to hand. We will also be running about 5 poll questions, and they'll be very useful for you in terms of benchmarking, so please make sure that you participate. We do try and look to get over 70% participation in our poll questions. The first poll question is, what percentage of your invoices are non-PO today? What percentage of your invoices are non-PO today? Is it 100%? 70 to 99%, 40 to 69%, 11 to 39%, or less than 10%. We're at 60% of you voting, so if you haven't done so, please do so, and I'll be closing the poll. We do always share the results, so you will get this information immediately, and ideally once we've got to 70%. So we're at 69, so if you haven't already voted, please do so to help us cross the line. Closing the poll in 3, 2, 1. 75% of you, 77% of you voted there. So coming up on your screen now, you can see the results. So interestingly and encouragingly, nobody on this webinar actually has 100% non-PO transactions, and only 10% of you fall into the 70 to 99%. And if we work our way down to the bottom, you've got 23% with less than 10%. And I suppose that's where the true definition of exceptions, if we think about it, because they are exceptions, come into play, where it is around less than 15 or 10%. So 23% of you coming in with less than 10% non-PO transactions. Interesting results. Back to you, please, James.
Thank you very much. And that actual result is of real great interest, and I'll tell you why, because it actually matches with some of the results I'm going to be coming and taking you through later on in the presentation. But let's first of all look at the challenges. What are the key issues with non-PO invoices? If you take a look at the key issues with non-PO invoices, or what I like to refer to as unexpected spend, the real impact on the business of the non-PO invoices is really directly related to cash flow forecasting and working capital management. The cost of processing non-PO invoices we've seen, and has been reported as well, to be around 15 times more expensive than a typical PO-based invoice. And with that also, non-PO invoices bring in a number of other issues, especially around the lack of visibility, which in turn impacts the cash flow of an organization, but as well as not being able to support the proper vendor management by making sure that invoices come from preferred suppliers. And without the standard process being followed, there are also huge opportunities being missed, especially around flexible payment options, such as capturing flexible discounts or dynamic discounting. But, as we mentioned before, there will always be non-PO invoices, and the objective really should be on how to manage these more effectively and to take advantage of early payment discounts on such, or reduce, more importantly, reduce the risk of late payment charges. Now, if you actually look at what does the industry say about this, we can actually go on to look at some industry research that was carried out by A.T. Kearney, American Express, along with Shared Service Link. And the industry feedback around this issue of what they called uncontrolled spend was very much about understanding how much money is being spent on products and services. This covers the vendor management, and it is critical for companies to really understand where their spend is going in order to make a decision on how they manage their suppliers. The second real item on that was being able to understand what is happening with companies needing to have greater visibility on the spend within their organizations and have the ability to monitor in real time where and when the unexpected spend is occurring. And lastly, if you actually look at the last one, we're looking at the better understanding of visibility that has been achieved. Then greater real controls and training can be put in place to reduce the level of unexpected spend. However, as I said before, it won't remove the problem entirely, as there will always be an unexpected spend. So organizations will still need the ability to manage the whole non-PO invoices, or even the fact that PO invoices with the exception hands that they have. Now, going back to the actual just recent survey, what was interesting is that the actual figures that we saw today actually reflect some research that was carried back by the Institute of Financial Operations in 2011. As I've already mentioned, that the level of non-PO invoices for shared service company in Sweden is well above the 90%. So obviously not many of those guys on the line today. But from our experience in Sweden, we have been there for over 40 years. We have seen the same experience of the high level of non-POs. Now, looking at the Institute of Financial Operations, how does this compare with the US market? Well, in their 2011 survey amongst their members, which is around 1,600 members, their spend in their organization, over a third cited that 35% of annual spend was based on non-PO invoices. And from the same audience, around 48% said on their received invoices, over 20% were from non-PO invoices. Now that's remarkably similar to the results we've just seen like 2 minutes ago from the first question survey. Now what we're BankTech are planning to take this research even further and sort of look at the other European markets such as UK, France, Germany and Netherlands. And when we have done that, we'll be more than happy to share the results. But certainly what it does show that in today's tough climate, it will be expected that companies are now becoming ever more focused on the cost control and adopting stricter practices around spend management to try and reduce that level of unexpected spend. Now we go on to Susie for the next question.
Thank you very much, James. So coming up on your screen now, poll question number 2. As a percentage, what percentage of your exceptions are indeed non-PO? Is it 100%, 75 to 99%, 50 to 74%, 25 to 49%, or is it 24% or less? So I'll just repeat the question. As a percentage, what percentage of your exceptions are non-PO invoices? 100%, 75 to 99, 50 to 74%, 25 to 49%, or 24% or less. If you don't have the exact figure, please, if you can provide an intelligence guess, that will really help us with our benchmarking here. So we're only on 51% of you voting. If you haven't already done so, please do so. We do like to get this over 70%. And I will be sharing the results. Closing the poll in 3, 2, 1. We're at 62% of you responding there. Let's have a look coming up on your screen now. So quite interestingly, 28% of you saying it's a quarter or less, and 25% of you say it's 3/4 or more, and the rest there are in the middle. So that's an interesting result there. Back to you, please, James.
Oh, thank you, Susie. Fantastic result there. Very interesting. And if you actually now look at, for example, what we were sort of talking about, the typical account payable KPIs, in basically how companies look to measure their performance. And this was carried out by a company called BPros with a number of other consultancy groups. What you can see is that the main items that can be seen on this table is that I would conclude that the innovator organizations have been able to manage their non-PO invoice and their exceptions more effectively than the rest. And by doing so, have been able to gain the real benefits around the reduced receipt to approval times. If you see, for example, in the first line, you got from the laggards 45 days right down to innovators of 5 days. High volume of electronic invoices. Again, with this one, you're talking about 7% to 67%, 7% on the laggards and 67% on the innovators. Now, that doesn't surprise me if you actually put the two together, because with the receipt to approval and electronic invoices, you would imagine that the actual time to approve will be much, much quicker due to using the power of electronic invoices. And at the same time, what we're seeing is the exception invoices coming right down as well. What we're seeing here is that, again, the innovators outstripping the laggards. Now, the greater benefits around the level of discounts and discounts captured, we can see sort of from 15% to 31% for as far as discounts being captured. In our discussion with other companies, we regularly hear the level of discounts captured is around 25%, meaning that 75% of opportunities are regularly being missed by AP departments. And that's an area that companies really want to start focusing on in order to manage their working capital and the cash forecast. But I believe that even the innovators, in some degree, are below the levels that could be achieved. And I believe that with greater focus, mainly around supplier engagement, making it easier for the suppliers to onboard to their systems in terms of ease and cost. And by that I mean is that one of the main barriers that we've seen, especially for smaller companies, is the high cost required for them to onboard to a buyer invoicing platforms, the startup cost, the actual cost per transaction. These numbers, I reckon, still can be improved significantly by using some of the latest sort of technology available, sort of services that are available. But it does show around the sort of typical APIs what organizations can do to improve their systems from being, even from the average to an innovator, and the impact it can have on their business, especially around cash flow forecasting and working capital management. We go on to another quick question from Susie at this point.
Thank you very much, James. Coming up on your screen now. And this is to do with how much more does an exception invoice cost you to manage compared with a straight-through invoice? There's a little typo there. So is it over 15 times, as James was suggesting, 10 to 14 times, 5 to 9 times instead of days, apologies for that, 2 to 4 times, or does it cost you the same amount to process an exception invoice as it does a good invoice, a straight-through invoice? So only 27% of you responding there. So just think about how much it costs you to process an exception invoice, and if you can just do the maths for us quickly, and let us know how much more does an exception invoice cost you to manage compared with a straight-through invoice? Over 15 times, 10 to 14 times, 5 to 9 times, 2 to 4 times, or does it cost you the same amount? So closing the poll, ladies and gentlemen, in 3, 2, 1. We're at 67% of you responding there, 69%, apologies. So coming up on your screen now, so 10% of you concur with James that it's over 15 times, which is a startling amount, that an exception invoice costs 15 times the amount of a straight-through invoice. And then you can see a bell curve there, but only 2% of you actually saying it costs the same amount. So again, really interesting results there. I mean, at least if I could do the maths quickly, well, 2/3 of you, over 2/3 of you saying it costs 5 times the cost of processing a good invoice or more. So really interesting results. Back to you, please, James.
Thank you, Susie. So that actually shows the price and the cost of the organisations of the non-PO invoices, the exception items. What I'd like to do now is really sort of take you on to the case study which I referred to, which is the actual shared services company. And in this section, I would like to, as I mentioned before, that this organisation provides accounting services to business from micro businesses, i.e. those with single owner, one employee type businesses, all the way to very large complex organisations, as I described around BankTech, but equally it could be something like a hotel chain. And the service, just give you some stats on the actual shared service company. It has over 50 medium to large customers, which have 26,000 suppliers among them. And those 26,000 suppliers produce over 500,000 invoices per annum. So it's a sizable amount of volume of invoices coming through. But not only that, it also has to deal with the cross-border challenge with customers who are suppliers in the UK and the other Nordic regions, such as Norway, Denmark, Finland. Now, as part of their business, it also supports what I mentioned earlier, the micro businesses, and these are organisations such as what we call the taxi drivers and the hairdressers. And these small companies really bring in their own challenges to the shared service company, because the shared service company is really acting as their accountants and finance department. And therefore, what they really do require is a robust and easy-to-use invoice approval process. So that can actually support their business and also cut down, as far as the shared services company, the amount of queries and outstanding and length of time it takes to actually process the invoice and other transactions. And usually what they want to be able to do is the taxi driver hairdressers want to be able to have access to their systems outside normal working hours. Now, while I picked this organisation, and there are similar organisations across Europe, for the type of organisations that exist, we believe to be around 5,000 similar organisations handling the same types of companies as the graph says, from a mixture of small employees of 5 all the way up to less than 100. The graphs actually show a survey that we did in March this year, and we found very, very similar results to those we experienced in Sweden. And interestingly, what we found was that e-invoicing is now becoming a key driver for these companies as they look to improve their KPIs and drive themselves more into the innovator metrics that we saw a couple of slides earlier. However, in order for them to do this, they need to manage their exceptional invoices and how they need to measure and how they handle them in an effective manner. And the challenges that the shared services actually have is that as far as change is concerned, the shared service company has to be able to handle and process large number of non-POs. In fact, as mentioned before, over 90% of the invoices are non-POs. They also have to be able to handle a mixture of clients from complex and the complex structure and a simple micro businesses. And therefore, they need a service that can handle the requirements of all types of companies. And in order to drive up the service level rates to their customers, they need a greater visibility of their transactions. But more importantly, they need to give greater visibility to both their suppliers and their customers in order to cut down the amount of queries coming through and also improve their overall efficiency. And once they have, in order to onboard such suppliers, they require a very simple and self-onboarding platform that's easy to use, cost-effective, but allows all different types of companies to use, whether they be the micro business all the way over to the very large complex. But once they have that platform for the onboarding, then they'll be able to allow the micro businesses to carry out their own approval of invoices in and outside hours. And as the system is far less complicated than the normal requirements of a large organization, it actually reduces the amount of time that the organization has to do looking after them, but also it also enables them to handle the typical exceptional items where there's no purchase orders for this type of documents or type of transactions. So really the KPI challenges at a high level are all around sort of accuracy of the invoice data coming into their organization. And that accuracy is both from all forms or types of invoices, whether that be a paper, a PDF, or EDI, or an e-invoice. And then once they've got that, then there's also the measurement of the volume of invoices and the breakdown by all invoices type. We've already seen, for example, the innovators, which had very high levels of e-invoicing, and the time it took from receipt to approve was very low. Again, the key push for these guys is to move a drive to e-invoicing, but also by going to e-invoicing, they can actually drive the cost down and support their customers far more effectively by actually making it, adding greater value to the service that they're giving. And as they improve the platform, they can basically raise the level of straight-through processing and at the same time improve their supplier support, but above all, enabling suppliers greater visibility of their invoices. And by this I mean at what stage their invoices is at, or they're being paid. And all of this can be done online or via mobile. So straight away we're reducing the level of interaction or queries that are coming through and pushing up the levels of customer service to their customers, but also supporting their suppliers greater, so therefore the suppliers feel a lot more comfortable with the overall process. And a key part of this is that using such a platform, it supports both PO and non-PO based invoices, as well as picking up the exception PO based invoice. And based on the information that's within the system, they then can create from the data proper KPIs and measures in order to measure their business in an effective way and give a better customer service to their clients. So how does it work? Well, if you look at the meeting and the challenge, by using systems such as BankTech's soon-to-be-launched BankPay service, companies are able to get through the straight-through processing by allowing the larger organizations to use the VAN network and enable the larger organizations to promote their VAN interoperability agreements, as well as giving access to smaller companies to send their invoices directly from ERP systems through virtual print drivers, or even to use a portal for the micro businesses to upload their invoices directly. So a multitude of ways of actually making sure the invoice received directly to the actual portal and reducing the receipt time, so therefore we can improve the receipts for approved. However, to get there, organizations such as BankTech, obviously we can assist by we take the holistic approach to handling invoices and allowing companies to send paper, PDF, as well as electronic invoices, and we can convert these along into the invoices with instant access and visibility of those actual invoices being said through. In summary, really sort of platforms such as BankPay is key really to around the improved efficiency of the AP process. It certainly allows you for the additional benefits such as working capital management, i.e. through the early discount programs, reduces costs for both the supplier and the buyer because it really does assist with reducing the overall approval process and the risk of the late payments, I said before. But also, with the metrics in place, it does enable them to have proper KPIs to measure the overall business and how they can increase their level, for example, of paper-based invoices to electronic invoices, from their receipt to approve, as well as increasing their discount capture rate on the same system. But that's all fine, but in order to actually support an organization such as a shared service, the actual platform has to be able to support the micro business, which is a single entity, all the way up to the very complex business, where there will be multiple entities in that one-side organization. And as I mentioned, the shared service has to be able to support the different types of companies, from the large to the micro business. And really, in order for this to happen, the platform required has to be able to support such a structure. Now, such as BankPay, that is able to handle the regional as well as the functional subsidiaries at a multi-level tier, all the way down to the micros. The key behind this is that it has to be easy to onboard. The pricing has to be attractive for all those to use it, and the organizations have their own ability to create their own business-to-business network. And really what we're looking at is a total open business network where organization can sign up and start actually sort of trading electronically between each other at a cost that's affordable to them, but also it's easy for them to use. By doing that, and we increase the level of electronic invoicing as well as cooperation and collaboration between the suppliers and the partners, what you will see is a greater improvement of the overall KPIs. And by that, you'll start to see a reduction in the exception processing of non-POs or the POs with exceptions. Okay, go on to the next question.
Thank you very much, James. So coming up on your screen now, I think is the 4th out of 5 poll questions. And this one is to do with days. So on average, how many more days does it take you to process a non-PO versus a PO invoice? So on average, how many more days does it take for you to process a non-PO versus a PO invoice? On average, is it 40 days or more, 30 to 39 days, 20 to 29 days, 10 to 19 days, or 9 days or less? So is it 40 or more days, 30 to 39 more days, 20 to 29 more days, 10 to 19 more days, or 9 days or less? So 73% of you have voted, so closing the poll now with the results coming up on your screen. So we got 75% in total. So interesting results there. Again, they're kind of almost like a pyramid, but you can see with a third of you coming in, or just over a third of you, saying it takes 9 days or less, more, if you will, to process a non-PO versus a PO. 39% of you saying 10 to 19 days on average more than the days taken to process a PO invoice, and 16% of you 20 to 29 days more. So interesting results there. Encouragingly, nobody's saying it takes you 40 days or more to process a non-PO over a PO invoice. So really interesting results. And back to you, James.
Thank you, Susie. I think what the next one said, so what benefits is the organisation, the case study organisation, getting out of using such a platform? And looking at just the first one, quality. Well, the first part about it is really the 100% accuracy of header item and line item fields from recognition. From this, they can actually pick up, whether it's the purchase orders on the line items information and start matching it through. And if it doesn't have a PO, straight away they can actually capture that information and actually process it and handle it accordingly. It also eliminates much of the time wasted by their own staff with dealing with errors that come through the actual APL process. Straight away they can actually pick up much sooner and allow for them to go more towards a straight-through process. That really sort of results in the last point, which is the far more improved, higher quality of service perceived by both the clients who can monitor the actual service, but also they have the ability to communicate with the actual scanning service provider, as in BankTech, directly, and therefore the overall quality is increased directly. And then because the platform allows people to basically connect electronically, this really sort of allows companies of all sizes to connect and start sending electronic invoices, both sending and receiving. And as I mentioned before, it supports an open B2B network. So it doesn't have to be a large buyer to a small company. It could be a large buyer to a large organization or a small business to another small business. It's basically a total virtual viral network that can create it, and by doing so, you enable greater efficiencies through the whole process. But at the same time, with more and more companies coming on board, the level of electronic invoicing can actually increase. And again, it helps that KPI to receipt to approve as well as onto the actual dynamic discounting that is now able to companies. And based around minimal no IT resources, it basically allows suppliers to connect to such systems through, especially the smaller ones, through sort of platforms that they're more used to dealing with, which is the sort of social media type platforms, whether that be the type of Facebook or LinkedIn or Twitter, those type of organizations, where maybe there's more the smaller size companies doing it, not so much the larger size. And also maintaining the sort of focus on the micro businesses. The ability to have a sort of like an easy approval, which allows the micro merchants to very quickly approve the invoices themselves, whether it be on a mobile device or online, in working hours or outside working hours. Again, it increases that overall level of customer service and the customer satisfaction that their customers receive. And again, one of the key KPIs is going to be around the level of customer satisfaction that the shared services provider provides to their customers. So in all, what we're seeing from the system, we've both brought in both the benefits of the actual quality, but also it's driving more business to become more electronically engaged through more of a sort of B2B trading type network. And as we go on to the last question.
Thank you very much, James. So this has got to do with transparency coming up on your screen now. Let's see if we can keep with those levels of participation, please. What level of transparency do you have for your non-PO invoices today? Is it excellent transparency? You can see all non-PO transactions end to end, from receipt of invoice right the way through to posting and payment. Good. Most non-POs are visible end to end. Maybe it's okay with around 50% of non-PO invoices not visible end to end or visible end to end. Or is it poor? You do not have visibility of non-PO invoices. So this one, as you can tell, is about visibility and transparency of non-PO invoices from receipt in your organisation through to posting. So if you can tick the box most relevant to your situation as it stands today. We're at 66% of you voting, so if you haven't already done so, please do tick the box most appropriate to you. Closing the poll in 3, 2, 1, coming up on your screen. So 15% of you have excellent visibility. You see all your non-PO transactions from end to end, so well done to you. 36% of you coming in as good, with most non-POs visible end to end. And then the remainder really coming in the last two brackets, with 28%, just under a third of you saying that you've got visibility over about 50% of your non-POs, and 21% saying it's poor, that you do not have visibility of non-PO transactions. So again, interesting results. Back to you, please, James.
Thank you, Susie. I'd like now to give you a little bit of information about BankTech, who we are, and also the new service that we're about to launch. We are actually launching a very new service very soon. It is called BankPay, and it will be available in June. And let me tell you a little bit more about it. As I said, BankPay will be launching. It is a cloud-based, open to B2B system network supporting P2P services. It offers, what we're looking at is an e-invoicing portal which has holistic management of all transactions, where these transactions be e-invoice, web form, PDF, and paper. It is own labeled for large organizations. A large organization can take it and actually add it to their own portal and make it their own look and feel. It does support the SME, and by that I mean the actual model that we're using is very much promoting the system so it allows small, medium businesses to get on board, making it cost effective for them to make so it's low cost, It's free for very small organizations and ramps up slightly for the larger ones. But above all, it is open for them to use. And if they actually register alongside and send invoices directly to shared service operators, there is actually no cost to them at all. So actually, for those, it's supplier-free model that they're using. It gives you a complete view of all invoice transactions, whether that be paper, whether that be PDF, and at what stage they are. And at the same time, with the mobile device that's on it as well, it gives you an excellent way of dashboards to see what's happening as well as alerts. And it is very much supported around the same concept of social business networking and self-onboarding, obviously supported by the BankTech team. And it really is aimed at every level of the business community. And with the actual collaboration features we have on it, as I said before, it's a total open B2B trading network. It has unique functions as far as like the organizational structure, which I mentioned, which we can handle a single micro business, right up to the complex business structure of multiple organizations, regional or functional structures reporting into a single head entity. But at the same time, it supports items such as foldering. So, for example, we need, for example, in the case of fraud management, you may want to make sure you have all the potential fraud cases put to one place for further review. It supports that type of activity as well as extensive dashboards and Excel reporting. It allows communication, one-to-one communication through an interactive note system that allows companies to actually send notes, keep them private as well as public, as well as a complete archive and approval system behind with a full content retrieval system behind it. And it's available online as well as on all mobile devices as well. So it is actually platform agnostic, and it's very easy, simple to use, and the way it's been set up is very much directed at sort of simple onboarding for the SMEs as well as the large organizations as well. But looking at BankTech as a whole, BankTech is basically, we're a US corporate. We've been around since 1972. Our revenues are circa around $250 million. We mainly sort of play in the financial services market. We are a BPO as well as a solutions provider company, a SaaS-based company, and we have BPO operations across the globe, across, for example, the US, all the way across EMEA, as well as into India. So we are able to support organizations such as very large organizations who require to have one partner in order to help them handle their invoice handling globally. BankTech has the ability and can, with their scanning centers and as well as the BankPay system, help the organizations to achieve that electronic invoicing as well as that straight-through processing and build up the benefits of the dynamic discounting they can come through. So look at the summary, coming up to the end, coming to the summary. So what are the key three takeaways? I think the main key takeaway is that non-PO invoices will always exist. And in the main part about it, the key is to how we manage them against agreed KPIs. Very much similar as with PO-based invoices. And the real driver for organizations is really to become the innovator. How do you get your receipt to approve from 45 days of the laggards to 5 days? How do you move your e-invoicing from 8% up to 67%? And I think that's a key point the driver going through. In order to hit and manage those non-POs, really to sort of look at the innovators and try and meet the same objectives of the innovators. And by that, you'll be able to get the benefits of your discount capture. And how you can do that are really for platforms like BankPay, that BankTech option, which enable organizations to manage both PO and non-PO spending according to the set KPIs for the management dashboards, and allow greater visibility for both the clients as well as the suppliers into how their invoices and the invoice management system. But at the end, really what it comes down to is the controls, visibility, and the organizational behavioral changes are really crucial for the interlocking requirements and the considerations in order to look at the unexpected payment or the challenge spend within the process. That's it. Thank you very much for your time. I'm James Silcroft from BankTech. I hope you enjoyed the webinar, and I look forward to your questions.
Thank you very much indeed, James. So we've got a number of questions coming through. Some are regarding the solution itself, and some are about general kind of non-PO transactions. So in your opinion, James, why is it that low volume suppliers generally and suppliers where supplier bases where there is the long tail seem to be the supplier bases that continue to send non-PO transactions?
I think at the present moment, what from our experience and who we've spoken to, it's really down to the cost and also the cost of setup for them to be asked, and then the cost per transaction. And really, I think that for the smaller guys on there, it's got to be more of an open approach and approach whereby the smaller companies can actually send their invoices without charge to the actual buyers. I mean, it is a cost and the setup cost for these guys. And until that problem is properly addressed, I don't believe that that tail will ever be tackled properly.
Okay, and you were talking a bit about the solution, and that you suggested that there was no charge for the suppliers, if I've understood correctly. Could you just walk us through the kind of the business case that a supplier might need to put together in order to sign up to something like this?
Well, certainly, for the smaller companies who send less than 10 transactions, like the micro businesses per month, then that the actual service will be free. But equally, if a supplier is sending invoices to, for example, in this case, to the shared service operator, then because the cost, that doesn't cost them at the present moment to actually send the invoice, whether it be PDF or paper, they can actually send through the actual system the actual invoices free of charge as they do at the current moment. So they'll actually get the additional benefit because they won't have the additional postage costs, because they'll be able to actually link on and actually network in to the shared service provider. Now, if those shared service providers decide to actually then go and use their system, or sorry, the suppliers to the shared service providers then decide to go and use their system and build their own business-to-business network, then they obviously will go on to a subscription type processing, because we believe that organizations are both buyers and suppliers, so they will receive and send invoices. So therefore, it's more of a subscription-based type approach.
Okay, and roughly, although it sounds from the session that the solution itself won't be widely available until 6 to 8 weeks away, June. Yeah. But based on your kind of pilots and based on the client that you were referring to there, yeah, how long roughly does deployment take?
We've deployed it internally within BankTech. We use it. We're a great advocacy of what we build, we use ourselves. So we have it up and running and using it. Now we are working with the shared service company in Sweden. We're in the process of actually onboarding their suppliers, their customer suppliers, as well as our own suppliers as well. So it's up and running. As always with all these things, the onboarding is the key aspect to it.
Okay, and you also talked about, we'll come on to onboarding in just a moment because I've got a couple of questions about supplier onboarding, but you talked about the fact that this could be a SaaS-based model, or am I right in saying it could also be an install model?
No, when we say white label model, it's basically a cloud-based model, so it's not really SaaS, it's cloud-based, but what it can be is white labeled. So for example, if a large organization, like a shared service organization out there, has already a portal that they're using for other financial processes, let's say payroll, then they could actually link the system into their own portal, and it will be white labeled so it looks exactly like what they have at the present moment. So that's really sort of targeting the larger organizations who will be able to do that.
Okay, and if an organization already has their existing workflow, how compatible is that with this solution?
There's a general API available, and if it tends for large organisations, what we will do is work with them in order for the API to link into their workflow system.
So is this actually going to work on a network kind of model where once a supplier, I understand it can take any kind of invoice type, be it paper, EDI, etc. But if a supplier connects to the platform through BankPay as well, does that mean that they're naturally connected to other buyers that will also join in the future over time?
They have what we have is a thing called we call the BankPay directory. So as new companies join in, they'll have access and the ability to go out and join against those that directory. So what will happen eventually will be the way we're doing it is very much like a viral networking business where companies can come on, they can invite their own suppliers, but equally they can actually look at on the suppliers on the BankPay directory and see what other suppliers or companies that they want to do business with, and then go out and invite them to start trading electronically through BankPay as well.
Okay, and as far as the supplier onboarding is concerned, is that something that BankPay does or will do, or is that something that the client would do?
We work closely with the client. For example, with the shared service organisation, we work very, very closely with them, helping them with the onboarding process, because we recognise that the onboarding is probably with all these. It doesn't matter what, if it's BankPay or any other type of platform, the onboarding is the critical part to get right, and also where you need to spend a lot of effort to make sure that you get to that 80%. But what we try and do with the onboarding is that we try and make it self-onboarding as much as possible. So it's easy to onboard and people can sort of gain access to the system very, very quickly. And then sort of built-in APIs to support them to do that.
And what kind of conversion rates over what period of time could shared services organisations expect when joining BankPay? So conversion from of suppliers. If we look at suppliers, or rather than perhaps electronic invoices.
Well, from paper to electronic.
So yeah, if we could choose the paper to electronic example, or the onboarding of suppliers.
I need to come back to you on that one. I don't have the actual stats to me at hand at the moment. It's still early days. Okay,
good. All right. Well, look, thank you very much indeed, James, for that very, very comprehensive overview. We look forward to giving everyone on this webinar an update over the next few months on the solution itself. Please bear in mind that Source to Settle as a Service is coming up on the 18th to the 20th of June. We've only got about 20 places left at that event. It's a really popular event, looking at translating the purchase to pay process into the service that really resonates with your customers. So make sure that you do register for that. And also we've got a number of webinars coming up over the next 6 weeks that will certainly be of interest for you. One looking at T&E improvements, that's taking place in May, and also KPIs, that's taking place in May, and also looking at converting shared services customers from lukewarm to delighted fans. So go on to sharedserviceslink.com to find out more about that. In the time being, many thanks to you, and thank you to James for your attention today, and look forward to welcoming you next time. Goodbye.